Hello and welcome to Headline. I'm Tony Keller in for Howard Green. Europe's banks are rushing to repay cheap three-year loans from the European Central Bank in another sign that credit markets may be loosening up in the struggling region. Some 278 financial institutions will repay 137 billion euros on January 30th. That is the first day that banks can repay loans early. Economists surveyed by Bloomberg had expected the banks to repay only 84 billion euros. Loans were all part of the ECB's long-term refinancing operations, or LTROs, designed to provide banks with emergency funding at a time when they were essentially locked out of normal credit markets. European Central Bank head Mario Draghi said today that we're seeing what he called positive contagion. So are the early repayments a sign that Europe's financial markets and economy are returning to health? For more, we're joined by Alex Drashevsky, founder and managing partner of risk management advisory firm Recovery Partners. Alex, great to have you here with us today. So you just heard that comment from Mario Draghi. He was speaking earlier today, and he said, you know, this is a case of positive contagion in credit markets, positive contagion kind of affecting equity markets. Is that what we're seeing here?
Well, thanks for having me. And yeah, Draghi's continually talking his own book. You know, he thinks he single-handedly rescued the euro. He single-handedly rescued the European banking system, but nothing of the sort is in fact occurring. And here's a fearless prediction. I don't think this trillion-dollar LTRO will ever be repaid in its entirety. What we're seeing today is 13% repayment on the earliest payment date. There are financial incentives pushing a lot of these banks to repay the loans because some of them can't find an economic home for the funds. They're having to pay interest on those funds of just short of 1%, and that's causing an earnings drag on some banks. And let's not forget the real issue here. There were two problems in Europe. Well, there are many problems in Europe. But regarding the banks, one had to do with liquidity and the interbank market and the fact that it locked up for a lot of these banks and they weren't able to get funding. The reason that happened is because of asset quality and the fact that there are a lot of bad loans in Europe. None of that has been remediated. There's been no remediation of the bad debt problem in Europe to date, and that's still hanging over this whole situation.
So why have we had months and months of equity markets going steadily higher, the shares in financial institutions going steadily higher, and now the banks saying, you know what, we can actually start repaying these loans? What's going on here? Are we all a little bit deluded about the situation?
Well, I think we are, because we're living off the euphoria of all the money printing that's gone on. And the money printing is in fact feeding into higher share prices, higher financial asset prices generally. It's not repairing the bad debt problem, but it's giving the impression that things are a lot better than they really are. It's like an alcoholic taking a drink when he's got a hangover. You feel better with a bit of hair of the dog. But this is by no means the light at the end of the tunnel. And I think the European Central Bank is talking its own book. They're on the hook. They've gone out on a limb with these policy moves. They better work, because if they don't work, we're going to lurch back into another crisis. And believe me, that eventuality is a lot more probable than many people think.
So for anybody who's invested in European equities, and a lot of people have piled into European equities since the summer, are they investing in something that has been getting actually more risky rather than less risky?
Yes, absolutely. As these prices tick higher, you're actually building more risk into the equation. And let's face it, a lot of the guys, this is a lot of hot money that's got in there. This is a trade, it's not an investment. And as soon as things turn, you'll see these people piling out. Now, let's wind back the clock a year. We're talking about fiscal union. We're talking about, you know, unified the bank deposit mechanisms. We're talking about a whole bunch of stuff that the Europeans were going to put in place in order to damp down the crisis on a permanent basis. None of that's happened. None of that's happened. We basically have slid through a year where nothing really bad has gone on. Nothing's tested the system. Nothing's tested the policies that are in place. And, you know, we're being told now that this is a success. But none of the patches, none of the long-term patches that were supposed to be applied have actually been implemented. Nothing.
So we've seen, if we turn from equity markets, talk about credit markets in Europe, anybody who invested in the summer in Spanish debt, Italian debt, Greek debt, they have done very, very, very well as the market has come to perceive these debts as far less risky. Are those people going to be sorry if they continue to hold those bonds?
In September 2008, Lehman's senior debt on the morning it went bankrupt was trading at 92 points out of 100. That evening, they were at 0. These markets can turn viciously, and we're in that type of a scenario where expectations and market prices can move very rapidly because there is only the pretense of liquidity out there. All of this has been backstopped by funding money from the central banks. And let's face it, Federal Reserve isn't turning its policy around. They're still printing like crazy. The Bank of Japan has just announced a huge money printing and fiscal stimulus program. So the Europeans are trying to stage manage expectations here. And as I say, I don't think they'll be successful. I don't think this LTRO money is ever going to be fully repaid off, the $1 trillion. I mean, they're only paying back 13% today. They might pay back another 10 or 12 next week, we're told, percent of the total amount borrowed. But there are banks out there that are pure zombies that will never be able to repay the money they borrowed.
I want to read you another quote of a certain amount of confidence. It's George Soros. Earlier today, Soros said, look, once the economy gets going, interest rates are going to take a big leap. So his fear is actually that the economy is getting better,
Yeah.
and there is going to be an interest rate move upward, and it could be sharp, and it could come relatively soon. He was saying this in Davos today. What do you think of that?
Well, that's a clear risk here, and interest rates have been manipulated down by the central banks and governmental authorities in Japan, in Europe, in Canada, in the United States, and you know that game of manipulation could end. It certainly would end if the economies responded. But one thing, again, that we argue is holding back the economies from responding to the stimulus is the fact that the detritus, the bad debts from the last crash haven't been cleared out. And those are continuing to weigh on bank balance sheets and corporate balance sheets in the form of uncollectible debts. Until that all gets remediated and flushed out of the system, the economies aren't going to be able to grow very strongly. There could be an interest rate response for other reasons. Inflation expectations going up because of all the money printing, for example. We're still very much not out of the woods here, Tony. We're still in a very dicey situation.
How do you feel about the U.S. Housing market? Today we got some slightly negative data, but we've had several months of what looks like continuous, gradual improvement in U.S. housing. That's where the problem started. Is this where it's ending?
You still have a huge shadow inventory of unsold foreclosed properties in the U.S. You still have properties that aren't yet foreclosed. It's too early to say that we're out of the woods, because compounding that is the fact that you've still got an employment problem in the States and the economy isn't growing, and that's weighing on people's expectations. What drove the housing market between 02 and 06, 07 was expectations of rising prices. And I don't think that Joe Public out there thinks he's going to be able to use his house as an ATM in the near future. That drove a lot of the buying. We don't have that expectation in the market. Sure, we're going to get bumps and upticks and this and that, but are we, into a new cycle of rising prices? No, by no means.
All right, Alex, it's always a pleasure to talk to you. Thanks for being here.
Thanks, Tony.
That was Alex Drashevsky, founder and managing partner of risk management advisory firm Recovery Partners. All right, coming up.